Only 30% of UK active mutual funds beat their benchmarks over the past 10 years. And it was even worse for global funds at 17%. So it begs the question, are mutual funds still viable? And if they are, what are some of the things that we should look out for when picking them? The first thing you'll notice when you look at performance figures of mutual funds versus their benchmarks is just how much they differ from different regions. The UK is around 30% that beat their benchmarks. But in the US, it's as low as 15%. And that's predominantly why it's dragged the global figure down to around 17%. This is down to a lot of efficiencies in those markets. And we'll come on to that in a little bit more detail and my advice of what I think you should do. But the first thing I just want to cover is, let's just break down how an active mutual fund actually makes money, because it's not on performance. If you have a mutual fund, you get your money from a fee that you charge annually on the assets under management, the AUM. So regardless of the performance, that fee is always going to be taken. So if you have a negative year, you might have well underperformed the benchmark, that fund manager is always going to take their fee. And the reason I mention this is more down to incentives. Now, of course, they always want to beat their benchmark. That's what they're going to be compared against. And of course, the more performance that they have in the fund, especially over a long-term basis, the more money they're going to have into the fund. But because they earn a fee based on the AUM of the fund, not only are they going to increase that amount if they outperform and obviously they grow the fund, but also they can grow the fund through inflows as well. And that's how a lot of them potentially could be incentivized. So for example, if you go and put a load of popular stocks, it could be Tesla, Apple, Nvidia, just to name a few, is that more likely to get you inflows into the fund? Because people are going to recognize those stocks. They might want to invest into a fund that holds them. They might have something personal towards those companies. And in which case, they might be more likely to invest into the fund, potentially regardless of any performance. And even though you might be able to hold those funds in an index fund, potentially based on the makeup of that active fund, they could be incentivized to put their money into the fund. So from a fund manager's perspective, if you start putting popular funds into your fund, that could be an easy way to increase the inflows into that fund. Now, fees from active funds have come down a lot in the past few years, and this is predominantly down to index funds and the more passive approaches growing in popularity over the past 5 to 10 years. The average for an active fund now is about 0.59%, but they used to be a lot higher. I used to work at the asset manager Invesco, and this is going back 13 years now. I started in 2012. And back then, the average annual fee for a fund was around 1.5%. And also bear in mind at the time, this is when people would invest directly with the asset manager. And they actually had a 5% initial fee, which is crazy to think nowadays, where you can invest on a platform like Trading 212, Invest Engine for no fees. And that annual fee is so much less now. But that's what it used to be. And people didn't know any other option because there was less competition. But now, because there's a lot more passive options, the active fund managers have had to bring down those fees. For those funds that average the 0.59% in the UK, remember, that's just based on funds that survived. So there's a survivorship bias there. Think about all the funds that underperformed their benchmark for years, that just relied on those committed investors that were loyal, that just enjoyed the fund manager and enjoyed the companies that they invested into. Some of those funds won't exist anymore because investors just got fed up with the underperformance, and they also saw that they could get better returns just by investing into the market via an ETF. But this isn't to say that all active funds are bad. Clearly, there's some really good active fund managers out there. And when we look to those figures, I always like to look at the 10-year ones, because you're always going to find some funds that might outbeat the market, and sometimes in a big way, for maybe 1 or 2 years. But that's not really what you want a fund manager for. You want a fund manager because you want to beat the market, obviously, long-term and consistently. And over a year, there's a little bit of luck involved. And you want to make sure that it's not just a one-off. So that's why I always like to look over a long period of time. But if you do want to go down the active route, what are some of the things that we should look out for? Now, this goes back to the graph that we showed at the start, where we showed the different regions and how much it varies. And what you'll tend to see is, in a lot of the bigger developed markets where they tend to be more efficient, it can be slightly harder for fund managers to beat the market. Because there's so much money involved, because those markets are so inefficient, then that's where it can be slightly harder. What you tend to see in some of the more developed markets is where you tend to find the outperformance. So it's going to be those smaller, less efficient markets that you're more likely to get a better return from an active fund manager. There's less information in some of these smaller markets. And that's where a fund manager who's really dialed in and has an expertise in that specific market, that's where they can really earn their money. Because the less people that covering that market, the less efficient it is going to be. Now, it's not to say that all active funds in emerging markets are always going to outbeat their benchmarks, but you can see the difference between some of the smaller markets and the larger markets like the USA. But it's not just emerging markets as well. It can be more specific sectors. So we're talking things like healthcare or technology. If that fund manager has a really deep understanding of that company, where they're going to see the boards, they're seeing how the company operates, that's when you can potentially earn some good money from it. Just take the healthcare sector, for example. Just thinking healthcare as a industry can be so varied, especially if you think about certain drug companies. A lot of their performance is based on the outcomes of test results and what happens in the back end. If you have a fund manager that has a deep understanding of how that company operates, that's where you can potentially earn some good profit. And the other area where active funds can be good is in market downturns and just general risk management. When the market is coming down and you just follow the benchmark, of course, you're just tracking the markets. You're going to come down with the market. It's not to say that an active fund can totally avoid any market downturn, but because you've got that active nature in there, they can employ certain tactics and different asset classes that can help to reduce some of that volatility. So depending on the type of the fund and actually the goals and the mandate of the fund, you could potentially reduce your volatility in it. Where if you just follow the benchmark, then obviously you've got to take the volatility that comes with the market. Say you're coming up to retirement, say you're coming up to a big purchase, potentially active funds could be a slightly better option if the idea of the fund is to slightly reduce volatility. Obviously, that's not always the case. Sometimes the mandate is to simply beat the benchmark. So just look out for what are the actual objectives of that fund. Of course, it doesn't need to be an all or nothing approach as well. You could have what I like to call a hybrid approach or a core and satellite type portfolio. So this is where you may have, say, 80% of your portfolio invested in passive index funds. You could have a global index fund where you're going to get the majority of your performance. It's very hands-off. You're not picking a specific sector you think that might outperform. You just sit back and you track the market. And then in the remaining 20%, this is where you can be a little bit more active. And it depends how active you want to be. For me personally, I like to keep my hands a little bit busy. So even though I know from a probability perspective, I'm unlikely to beat the market, I do enjoy picking a few single stocks and something that's a bit more niche. Now, you can do this with active funds as well. My main advice with this is try not to get an overlap. So if you're investing into, say, the S&P 500, and then you also find an active fund, which their goal is to also beat, say, the American market, it's likely they're going to have a lot of funds that are going to overlap. You'll even find this in global funds as well, because a lot of those American funds are so big. Even if you have a global fund, if you then have an active fund that's trying to beat the global market, they might still have your technology funds like Apple, Nvidia, Microsoft, etc. So just bear in mind so you don't overlap your portfolio too much. The other thing you could look at is look at those active funds that are more likely to beat their benchmarks and ones that have done it historically. So things like the emerging markets and those smaller, slightly less efficient markets. So just as an example, and this is not financial advice, but you could go into a global index fund, but you could pick one that is just focused on developed markets. So something like a world fund rather than an all world fund, which excludes those less efficient and emerging markets. And then from an active perspective, you could then invest into an active fund that's trying to beat the emerging markets. And that way you're not going to get the overlap. You're investing into the active side is more likely and historically has beaten the benchmarks, but you've still got the majority of your funds invested into the passive side of the market that you can just sit back and let it do its thing. So that's just one way you could do it. And that leads me on to some of the red flags and some of the things you need to look out for when you're choosing your active fund. The first thing is to look out for is too much of overlap. And this is what we call a closet index. So if you have an active fund that is very similar to an index, from a performance basis, because they're so overlapped, it's going to track that index fairly well. But because they're an active fund, they can charge a higher fee for it. And what you end up doing is essentially just tracking the market, but paying more for the privilege. And active fund managers have gotten away with this for years and years, especially before passive funds really took off and the popularity has grown in the last few years. And that's a lot down to why I think the fees have come down for active funds so much, because they have to be more competitive. And you can find this information in the top 10 holdings. You can look at the fact sheet, wherever you get your information from for the fund that you're investing into. You don't always have to look at it on that company's website. You can find it on a fund supermarket or anything like that. So just look out for overlap. The next thing to look out for is frequent fund manager changes. So ideally in an active fund, if you've got a fund manager that's been there for 20 years, especially if it's a more specialized area, you've got high conviction, high confidence that fund manager knows exactly what they're doing. They've got a good track record, and you can have the confidence that this is where I want to put my money. If you have a fund where the fund manager is changing every couple of years, you've got to ask yourself why that might be happening. Is it down to underperformance? Is it down to poor outflows from the fund? Is that fund manager not always aligned with some of the analysts and maybe some of the other managers in the team? So that would be a little bit of a red flag. Not on its own, but it would just be a bit of a warning sign for me. The next one's quite an obvious one. It's just generally high fees, especially when it's combined with low performance. I wouldn't necessarily put too much attention on performance over the last year to date. I'd be looking more over the 5 to 10 year period. And if it's got a generally underperformance over that longer time period, and you're paying a higher fee for the privilege, then that would be a red flag for me as well. And the final red flag for me is when a lot of the marketing is based around the past performance of the fund rather than the process. So for example, you can have an active fund that way outbeats its benchmark for one particular year. It could have got lucky with one particular fund, whatever it is. Say it outbeats the market by 10%. If a lot of the marketing is based on, look what we did last year, we did 20% when the market only did 10%, that should be a little bit of a warning sign for you, because we know that because it outbeat the market so much, we haven't got the track record to confirm it can do it on a long enough basis. And you want marketing to be focused on the process for the fund. So around the objectives, how the fund manager is going to beat the market over the long run, not just how it did it over 1 year. And you can see from a marketing perspective, it can be so tempting because obviously the more inflows they get into the fund, and generally when it has had a really good year, you are going to get more inflows into the fund. And that's obviously going to earn them more money. But just watch out for looking, and that goes back to our point about looking at just 1 year's worth of data. Make sure you look over a long enough time horizon. The other thing from this that is talked about quite a lot is because of how popular passive funds have got, and I think it was in 2023 where passive funds actually beat active funds for the first time in terms of AUM, is people ask the question about, if most of the advice out there is just to put your money into a passive index fund, what if the whole market does that? Are we going to end up in a situation where, say, for example, like the biggest companies in the world, because they're always at the top of the indexes, whether that's S&P, whether that's the global market, if people are just having a passive approach, those companies are just going to continue to get bigger and bigger. And I think a lot of people are starting to get a little bit worried by this. And the thing I always say about this, if this is a concern for you, is if we ever to get to that state, then the markets would be so inefficient. And in a way, that actually creates more opportunities for active fund managers and active individuals. Because what we're essentially saying is that we're just investing money into the market regardless of performance, regardless of earnings per share, cash flow for those companies. And what that means is that we're then not efficiently valuing those companies. And actually, that creates more opportunities for active fund managers or individuals. The other thing is that I don't think we'll ever get there, because as much as we can always advise people to put their money into passive approaches, people will always want to beat the market. It's that thing about, even though the probability is very, very low, people will always think, I can do it. Naively, whatever it is, people will always think, yeah, I can still beat the market, regardless of what the stats might say. And there's always going to be fund managers out there who will do it over a long enough basis. And there will be fund managers out there who can beat the market over the long run. And in a market where it is becoming more competitive, it's those active fund managers that are going to rise towards the top. Because if you can do it over a long period of time, then people are more likely to trust you, especially in a more competitive environment, knowing it's not just a one-off. And that's where I think there's still going to be a big market from it. So if you're ever worried about, what if index funds grow too big, the market's become too inefficient, I wouldn't worry about that too much. So are mutual funds completely dead? No. Are they overpriced for what they deliver? Absolutely. But the key is being selective and being honest about what you're actually paying for. Not just looking at those one-off years, looking over a long time horizon and making sure they can not just beat it in 1 year, they can consistently beat the market. And look at those specific regions about where you're more likely to beat the market over the long run. What's your experience with active funds? Have you got any that you think that have well outperformed their benchmark over a long period of time? Let me know down below in the comments. I'm generally curious about what UK investors look for now, whether they just totally go for a passive approach or whether there are still a few specific active funds that are really good out there. Let me know. A little bit of a different video today, just walking and talking, hopefully a bit more conversational. I'll try and do a few more of these. Hopefully it will improve over time as well. Just trying to talk a little bit more free flow to the camera. But yeah, let me know your thoughts down below. And if I missed anything, also put that as well. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.